The Reserve Bank keeps the cash rate on hold. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee and well, the Reserve Bank has done it. They've kept the cash rate on hold and I'm going to bring up an old chart which we haven't looked at in some time. This is the cash rate target. Frankly, I didn't update it since 2023. So you can see, if we look back at that chart, look, before 2014, 2010, around there, see we're up above that 4% line. So we're climbing back up into the band of normal rates. We're in a normal period now where the rates are. And you've got a lot of people there hoping, desperate for a crash in rates down to 0.1%. But this is just a once-in-a-lifetime event. I would be shocked if we see it again. We've been on a downward trend since the GFC, and I suspect we'll hover around this area for some time. I don't think we're going to see the crazy rates we did in the past, unless, of course, something insane happens, which, well, that's kind of like life. So let's have a look at the statement from the Reserve Bank governor here. So, at its meeting today, which was yesterday, the board decided to leave the cash rate target unchanged at 4.35% and the interest rate paid on exchange settlement balances unchanged at 4.25%. So inflation continues to moderate but remains high. Recent information suggests that inflation continues to moderate in line with the RBA's latest forecast. The headline monthly CPI indicator was steady at 3.4% over the year to January, with momentum easing over recent months driven by moderating goods inflation. Services inflation remains elevated and is moderating at a more granular pace. The data are consistent with continuing excess demand in the economy and strong domestic cost pressures, both for labour and non-labour inputs. Well, I'm sure forcing everyone to pay more for their mortgage repayments is going to address all of those issues. Certainly, yeah. High interest rates are working to establish a more sustainable balance between aggregate demand and supply in the economy. Accordingly, conditions in the labour market continue to ease gradually, although they remain tighter than is consistent with sustained full employment and inflation at target. Wages growth picked up a little further in the December quarter, but appears to have peaked, with indications it will moderate over the year ahead. Nevertheless, this level of wages growth remains consistent with the inflation target only on the assumption that productivity growth increases to around its long-run average. Inflation is still weighing on people's real incomes, and household consumption growth is weak, as is dwelling investment. The outlook remains highly uncertain. While there are encouraging signs that inflation is moderating, the economic outlook remains uncertain. The December quarter national accounts data confirmed growth has slowed. Household consumption growth remains particularly weak and high amid high inflation and the rise in interest rates. After recent declines, real income have stabilized and are expected to grow from here, which is expected to support growth in consumption later in the year. Meanwhile, growth in unit labor cost remains very high. It has begun to moderate slightly as measured productivity growth has picked up in the past 2 quarters, but whether this trend will be sustained is uncertain. The central forecasts are for inflation to return to the target range of 2 to 3% in 2025. Yeah, and to the midpoint in 26. So we'll have to see. I mean, you've got to understand. Hang on, let me bring up this one here. We'll go to the RBA. We've got inflation, and you can see here in the chart, there's the range. So, yeah, they were hovering. I guess the range should be probably a bit bigger. So that's the target. Well, I'm assuming that's when it was introduced. So, at least it's not as bad as the 70s, the 60s, and the 80s, hey? There you go. Except for this. This is why. See this? Look at this. Look how flat inflation has been over the last, since 2020 years. You've got people whose entire working life, they've never encountered any serious inflation. So no wonder all of these businesses are struggling to deal with the challenges they've had to face. So, employment is expected to continue to grow moderately, and the unemployment rate and the broader underutilization rate are expected to increase a bit further. While there have been favourable signs on good price inflation abroad, service price inflation has remained persistent, and the same could occur in Australia. There also remains high level of uncertainty around the outlook for the Chinese economy and the implications of the conflict in Ukraine and the Middle East. Domestically, there are uncertainties regarding the lags of the effect of monetary policy and how firms' pricing decisions and wages will respond to the slower growth in the economy at a time of excess demand and while the labour market remains tight. The outlook for household consumption also remains uncertain. So returning inflation to target is a priority. So that means, I wonder if we could potentially see rate hikes. Returning inflation to target within a reasonable time frame remains the board's highest priority. Remember when when it was just transitionary or transitory? Remember that rhetoric coming from the Fed? Oh, it seems so long ago now. Because it was. This is consistent with the RBA's mandate for price stability and full employment. The board needs to be confident that inflation is moving sustainably towards the target range. To date, medium-term inflation expectations have been consistent with the inflation target, and it is important that this remains the case. While recent data indicate that inflation is easing, it remains high. The board expects, remember, even if inflation goes back down to the target band they want to achieve, or even close to it, hovering around it, prices are still going up. The board expects that it will be some time yet before inflation is sustainably in the target range. The path of interest rates that will best ensure that inflation returns to target in a reasonable time frame remains uncertain, and the board is not ruling anything in or out. Okay, so there's another article there where they're predicting 6 rate cuts or whatever. They're not ruling anything out. They may go up. They may go up. There's another video I want to look at. We're out of the period of negative interest rates now. The last country to have them, they've gone. The board will rely upon the data and evolving assessment of risks. The board will continue to pay close attention to developments in the global economy, trends in domestic demand, and the outlook for inflation in the labour market. The board remains resolute in its determination of returning inflation to target. So let's have a chat about this one. So, well, there we have it, guys. They're not committing to anything. I guess they've learned from the mistakes of the past where the media would jump on the bandwagon, jump on the headline. I mean, we were not meant to get any increases in the cash rate until 2024, until now. What does that teach us all? Is that the real fake news that we shouldn't trust? Anyway, let me know your thoughts and opinions on this one. Take care, guys, and I'll see you in the next episode of HeiseSays. Bye for now.